SpaceX went public with a bang, hitting a peak valuation that briefly made it more valuable than almost everything except gravity itself. But if you think you missed out by not buying the dip at $225, I'm here to tell you that you didn't miss out. You dodged a financial IED. While the finance bros in their Patagonia vests are high-fiving and slinging zins over the post-IPO pop, the underlying math of this deal is so utterly broken that it makes the 2000 dot-com bubble look like a sensible savings account. By the end of this video, I'm going to show you why this orbit is actually a black hole for your capital. We're going to cover why SpaceX is a ticking bomb, how a fast entry rule on the NASDAQ is turning you into the bag holder for insiders, the Cisco 2000 playbook that proves being a great company doesn't make you a good stock, and why the AI pivot is just a fancy term for an unprofitable cash incinerator. Let's pop the hood on this digital mirage. To understand why SpaceX is a ticking bomb, we have to rewind the tape. We've seen this movie before, and it doesn't have a happy ending for the retail investor. Remember Cisco Systems in the year 2000? Cisco was the backbone of the internet. They made the routers that powered the digital revolution, a real company with real revenue and real dominance. At its peak, it was the most valuable company in the world. Sound familiar? Then the dot-com bubble burst. Cisco lost nearly 90% of its value. The crazy part? The internet did transform the world exactly as predicted. Cisco survived. They remained a major player. Yet it took them over a decade to reclaim that peak. As one analyst recently noted, a great company can still be a poor investment if the price is too high. Now, look at SpaceX. It's trading at roughly 94 times trailing revenue. Yahoo, at the peak of the dot-com bubble, was trading at 119 times sales, and that was considered insane. Economist Henrik Zeberg is sounding the alarm, stating that this current valuation surpasses the peak price-to-sales ratio of Yahoo during the 2000 dot-com bubble. The pattern is repeating. The story is so massive, Starlink plus rockets plus AI equals space god, that investors are ignoring the math. Massive net losses, an unproven AI pivot, and crushing debt. History isn't just repeating, it's rhyming in a way that is about to bankrupt the retail gamblers who bought the hype. Now let's get to the mechanical gotcha. This is where the game is rigged. First, the retail exit liquidity trap. SpaceX raised $75 billion in the public markets, the biggest IPO ever. You'd think they were selling shares in the future of humanity. But Scott Galloway, the NYU Stern professor, pointed out something crucial. Typically, IPOs reserve 5 to 10% of shares for retail investors, you and me. The rest go to smart money. But SpaceX set aside as much as 30% for retail via apps like Robinhood. Why would they do that? Because the institutional investors, the guys who actually do the math, were not willing to absorb the full deal at the requested price. They knew the valuation was a fantasy. So Elon and his team used you, the retail investor, as exit liquidity. They used the hype to dump shares into your Robinhood accounts so they could fund their cash-burning AI ventures. Second, the black hole balance sheet. Let's talk about the core business. Starlink is a gem. It generates revenue, but the rest of the house is on fire. SpaceX posted a net loss of nearly $5 billion in 2025. They spent almost $13 billion on AI infrastructure, more than they spent on rockets. They've issued a $25 billion bond deal to refinance the debt from the failed Twitter acquisition and XAI. This is like using your credit card to pay for a bachelor party in Miami at 2 in the morning. You might be having fun, but the hangover is going to destroy your credit score. Third, the fast entry rule. This is the scariest part. The NASDAQ just changed the rules. Previously, you had to wait 3 months to be added to the NASDAQ 100, but for mega-cap IPOs like SpaceX, they cut it to just 15 trading days. Why does this matter? Because it forces passive index funds like the Invesco QQQ to mechanically buy billions of dollars worth of SpaceX. JP Morgan estimates the inclusion could trigger about $4.3 billion in passive inflows. This creates a temporary artificial floor for the stock, allowing insiders to unload their shares at inflated prices before the lockup periods expire.
It's a brilliant, cynical move that lines the pockets of the elite while creating a price anchor for the rest of us. You don't have to take my word for it. Look at the experts. Elon Musk shocked everyone by acquiring xAI, the makers of Grok, and merging it into SpaceX. Then, in another massive signal of weakness, SpaceX used its inflated stock currency to execute a $60 billion acquisition of Cursor, a coding app. Ray Dalio would look at this and see the conglomerate discount immediately. When you mix aerospace logistics with social media, auto manufacturing, and AI software, you create a mess. Institutional investors hate complexity. They punish it. They discount it. This move signals to the market that they are buying hype to justify the price, not building value. The stock is now trading around $165, a 25% retracement from its high, as the market realizes they are paying a premium for a company that is essentially a collection of disparate, unprofitable side projects. Now, because I'm a macro truth teller and not a sell-side shill, I use tools to see through the noise. I'm not looking at the headlines, I'm looking at the data. I use TradingView to map out the correlations, the macro indicators like the rising bond yields that are crushing high-growth stocks, and the options flow that shows the whales are going short. While CNBC is telling you to buy the dip because space is the future, I'm using TradingView to see the supply walls and the institutional selling that is about to flood the market. It's the research engine for skeptics. Here is the eventual reality. There are 13 billion shares outstanding in SpaceX, but only about 5% are in the public float. In December 2026, the lockup period ends. That means potentially billions of shares held by early investors and employees hit the market. That sudden supply, combined with the fact that the company is burning cash and won't be cash flow positive until 2029, means the stock price isn't just going to drop, it's going to crater. SpaceX isn't going to fail. They're going to dominate space, but the stock is in a bubble. You're buying a ticket to Mars, but you're paying the price of a private jet. When the insiders sell, the passive fund inflows dry up, and the macro environment with inflation at 4.2% pressures Starlink margins, the house of cards collapses. This channel exists to cover what CNBC won't touch, the ugly reality behind the glossy headlines. The SpaceX bubble crash is mathematically inevitable. Don't be the bag holder. The people living in the economy, the ones trying to pay rent, know a scam when they see it. Now you do too. Let me know in the comments. Did you buy the IPO? Are you feeling the FOMO? Or are you a skeptic like me? Subscribe if you want to hear the truth that the mainstream media is too afraid to print. I'll catch you in the next one.